So depending how far the premium was out for the expiration, that could actually be a loss if you chose to exercise that contract. I mentioned calls and puts already, so we need to quick define what a call and what a put is. A call is usually purchased when you think a stock price will go up, and a put is purchased when you think a stock will go down. A call option gives the buyer the right, but not the obligation, to purchase 100 shares of stock at the strike price of which you chose. Call options are considered in the money when the current price is above your strike price. And call options are considered out of the money whenever the underlying stock is below the strike price. Put options, as I briefly explained, is when you think the stock will go down. So you would buy a put option if you believe that, we'll say Apple, for instance, is going to trade lower. You would buy a strike price that is less than the current stock price because it would be out of the money. And if it fell below your strike price, you would be considered in the money. Remember, for a put option, you want the stock to go down. Now that we know the quick difference between a call and a put, we'll just go with some examples and risks. There is a high potential risk if the stock does not go to the strike price that you thought it would before expiration. You pay a premium to own the contract, and that it will go to that underlying price. After the expiration date, the contracts are worthless. So if I owned a stock option contract that expired yesterday, 9/11, today it would be worth nothing unless it was in the money and it was exercised. Call risk is limited to the amount of premium you paid for the contract, but it has a theoretical unlimited upside potential. Put risk loss are up to the premium paid, and the maximum profit is capped out as if the stock were to drop to zero, which is still a very large sum of money if it dropped to zero. In the money options nearing expiration, in my opinion, should be sold unless you really want to exercise your option contract. If you're in the money on a contract and it expires, it will exercise unless you sell it before that time. So if you do have to, if your option does exercise automatically because you didn't sell it, you need to have the capital required to cover that contract. Some platforms like Robinhood will sell your contracts 1 hour before closing if you are in the money and do not have sufficient funds to cover the option, or if you own the put and you don't have the 100 shares, you obviously can't sell those 100 shares, so it would sell your option premium for you before closing. I'll just run over a couple quick scenarios about some option trades. So example one, we're looking at ticker QQQ. We chose a strike price of $2.90 to expire by 9/11. We paid $1.19 per contract, so 119 total dollars paid. The current stock price is $283.50, so the call option is out of the money. But when it expired yesterday, it traded at $287. So because the stock was below the strike price of $290, that contract would expire worthless, and I would lose the entire $119 or 100% of my premium paid. Another example we can use real quick is a put option. We'll go ticker SPY. We're going to choose a strike price of $338. Used yesterday's expiration as an example. And let's say I only paid 50 cents per contract, so $50 total, because the stock is trading higher at $345. But on Friday, it takes a huge dip and goes down to $331 per share. This would have me at a value of about $7 per share of profit. So $7 of profit times 100, I would have about $700 of value in that option contract, which I only paid $50 for. That is a very large percentage gain, and I would highly recommend you sell that if you did not own the underlying stock. So as we can see, we can understand a little bit more about the basic options and how you can make money and take advantage of price movements. They can be difficult to understand because you must get the price, the time, and the direction correct to make serious profit. As we said, calls are purchased when you think the stock will go up, and puts are purchased if we think the stock is going to go down. Options differ from stock because they involve a strike price, an expiration, and you're paying a premium. Options are very risky, and if not traded correctly, could result in significant losses. Always be smart with your money and know your limits. Do not use money that you are not willing to lose, or if it could have negative repercussions on your life. Options are just one aspect of the stock market and should not make up your entire portfolio. Trade small, trade smart, and take profits when you can. Thank you.